I'll start with a cute little story. It's a little bit of a joke, and the accountants in the audience will appreciate this. This guy's floating in a hot air balloon. He's about 25 feet above the ground, and he looks down, and he's lost. He doesn't know where he is, but there's a guy standing down there, and he yells down, "Hey, where am I?" And the guy looks up, and he goes, "You're about 25 feet above the ground." And the guy in the hot air balloon looks down and says, "You must be an accountant." And the guy goes, "Yeah, wow, how'd you know that?" And the guy in the balloon says, "Because what you told me was absolutely accurate, but totally irrelevant." What I need you to do is tell me not only where I am, right? This is the shift. This is the mindset that's different from your 25 feet. You're accurate, but that's not going to help me to get where I'm going. And so looking at their books and seeing a problem, telling them there's a problem, does not solve the problem. The guy, a great accountant, a good advisor would say, "Well, you are at, latitude and longitude this, but more to the point, where are you going? Where do you want to go? And let me help you re-navigate your way to that new place." I think of accountants as kind of a GPS for small business. That when somebody has a path they want to get to, that we're in touch with what that path is as the client begins to deal with all the factors in their market, their industry, their customers, their employees, their cash flow, their banking, the economic issues that impact every business owner. Their business is going to need to course correct. When we first got those little TomTom navigators in our car, they would talk to us and say, redirecting, right? That's essentially what the role of a great accountant should be for their clients. Where do you want to go? Here you are now. What's it going to take to get from here to there? And maybe you need to plant that balloon on the ground for a few hours and get it refueled, and you don't have enough fuel to get to where you want to go. So typically what happens is the accountant shows up when the guy is, he's crashed his balloon. Instead of watching, well, where do you want to go? And okay, you don't seem to have enough fuel to get yourself there. Come on back down. Let's regroup, and then you can head out again. And I'll be your ground crew to make sure that you can fly as high as you want and far as you want to go. So a typical example of this is even something as simple as the chart of accounts. Most accountants give their clients, their business clients, a standard chart of accounts. And that's okay as a starting point, just to begin to create some buckets for income and expenses. But really, when you look at how most chart of accounts are structured, they're structured specifically for tax preparation. They are not structured for management decisions. And so our process is called the level 5 service model. And level 1 are those compliance-oriented services. Those are the traditional foundational services that every accounting firm provides. And we're really good at making them accurate, but not relevant. And the way that we make ourselves more relevant and truly add value, and this is important for every, not just CPA, but every bookkeeper, anybody who's involved in touching the chart of accounts or preparing financial statements based on a specific chart of accounts, is to go back through that chart of accounts and look for ways to restructure them so that we can begin to get dashboards specific to specific areas of performance, product lines, service lines, activity centers, so that everyone becomes an intrapreneur in the company because they're getting feedback about how they're performing in relation to, so that it's relevant, in relation to what the goals and strategy are of the company. And so by just taking something as easy as looking at the chart of accounts and breaking it out, recategorizing, reclassifying all the different entries in a way that all of a sudden now I can pull a little, a modified P&L for a given department. I can look at what their direct inputs are. I can look at what their outputs are. And all of a sudden that department has its own sort of entrepreneurial feedback loop to be able to course correct on its own. And so when I talk about, most accountants come in and clean up the mess, they don't even clean up the mess. They just tell the client that your house is on fire. They don't show them where the hose is. They don't show them how to turn on the water. They just tell them their house is on fire. And it's, there's a bunch of commercials these days like, "Oh, you wanted me to fix the problem? I'm just here to monitor the problems," right? I think a lot of accountants have gotten it in their head that independence means detachment. And over the years, working with the AICPA and experts in the profession, they've done a much better job of beginning to define what independence looks like. And as long as we are not making the decisions, the management decisions for the client, anything we can do to improve the quality of information for those decision makers is a value add. And in fact, almost 20 years ago, the AICPA did something called the Vision Project, and they did an industry-wide assessment of the future of the profession. And the thing that they said was going to be the most important role for any accountant going forward would be to improve the quality of information for decision makers so that they make better decisions in the moment, not 3 weeks or 8 months after the fact when they finally get their books closed out. So when you're asking about, what is the mess, it can be anything from they can't make payroll, they aren't going to be able to keep up with their loan payments, or they're missing opportunities to expand their company because of how they're focusing their resources. So it's really, it requires a level of business, and I'll use this word very specifically, intimacy, deeper knowledge of our clients' businesses. And for any accountant who has a niche practice, you know how cool it is to know, I do chiropractors, and so I know how chiropractors operate, and I know what a chart of accounts looks like for a chiropractor. You get systems and niches, you start to build some greater efficiencies for your business, right? That's why we like niching, is we become experts and we get better at it, and we systematize our unique intellectual properties around that niche. By adding in advisory to a niche-oriented practice, you now are going to know more, not just about the financial aspects of that industry. You're going to know about the performance aspects of that industry. You're going to know what it takes, what are the key performance indicators, key predictive indicators that are most critical to that business. I'll give you a fun example. This was a story in Inc. magazine, and if you ever want to have fun, just Google Inc. magazine and search under their key performance indicators or metrics, and you'll see hundreds and hundreds of stories that they write about this. But this one in particular has stuck with me. A restaurant owner began to notice a particular behavior pattern in his restaurant, and he began to sort of put some numbers to it. And what he discovered is at 8:30 at night, he could go out into his reception area, count the heads waiting to be seated, and essentially know what his gross receipts were for the day. Now, he could call in from Bermuda at 8:30 at night and say, Hector, how many people in the waiting room? And essentially know what his gross receipts are for the day. Now, that doesn't get him to his bottom line, but assuming all other things remain equal, the only variable in his scenario is the number of customers coming through. His costs remain the same, his staff is the same, his costs for food are the same. He gets a pretty good sense. He has a predictive indicator of what's really going to be showing up on his financial information. Most, if you ask a business owner how they measure their profits, they'll get right to the equation, revenue minus expenses equals profits. But what I've discovered, and I think anybody who spends any time really focused on performance measurement will learn, that you measure the revenue minus expenses, but those are the lagging indicators. What we're really looking for, and what the accountants can become very adept at with the right mindset, skill set, and tool set, is that we're looking for the predictive indicators, the leading indicators, not the lagging, but the leading. What are the behaviors, the day-to-day activities that are going to have the greatest impact on our bottom line? And, Jan Carlson wrote the book Moments of Truth, and he talked about turning around Scandinavian Airlines from a massive loss to a massive gain. And he said, we didn't set out to make one thing 1,000% better. We took 1,000 little things and made them 1% better, right? So it's not huge order of magnitude shifts in the business. It's incremental Kaizen, or what the Japanese would call continuous improvement, Kaizen improvements over time that begins to really crank up the heat of performance in that business. And so where accountants can be involved is helping their clients, one, make sure the information that's going into the financial statements is organized in a way that is far more relevant to the goals and strategy of the business. From that, we can build a business dashboard, something that includes both the financial metrics and the non-financial metrics that are driving the critical behaviors in that business.